The trading dynamic has pushed U.S. markets to record highs. We're hovering just around there right now. Is this a situation where the path of least resistance is to the upside as opposed to down?
So you've got fundamentals and you've got positioning, right? And your positioning is really what's driving the market higher. You've got a lot of investors that have looked at the fundamentals of the world, economic slowdown, trade war, Brexit uncertainty, elections in the UK, obviously, and they're thinking to themselves, okay, I don't need to be invested right here. And that ultimately is what's pushing us technically higher on a day-to-day basis. So
but why? How does that negativity actually move markets to the upside?
So there's two things. First of all, you've got a lot of systematic and momentum funds that have participated in equities that are driving from a futures perspective. And secondly, it's climbing that wall of worry. We're in an environment where actually the net negative news has been slowly priced out. The rhetoric on the trade war is actually improving dramatically, and I guess we can discuss that in a bit detail. But effectively, that climbing that wall of worry is what ultimately is pushing equities higher.
So you mentioned that positioning. As traders out there and investors in aggregate are setting up for the year end, one of the considerations they are probably thinking about is what happened last year. Boy, did everyone get shocked at the downside momentum in the markets last year. Is this a scenario where that is possibly going to play out again this time?
I think by virtue of the fact that we're all talking about it, could we have a repeat of Q4? It means it probably isn't going to happen. But and when you actually look at, again, the actual details, you can see that retail positioning's come down. That was very elevated this time last year. Again, institutional positioning has also come down quite dramatically. And actually, in terms of hedging, rather than hedging the downside, we're actually seeing more investors looking to hedge the upside, i.e. we're beginning to see the cool wing of the options market going bid.
Now, what's interesting about that, if you say that there is a lot more hedging to the upside, that implies people buying insurance on moves higher in the stock market. Every time people do that, it seems to me that's what causes a slow grind higher, right? As people sell more upside insurance, they have to buy more stock to hedge out that exposure that they're selling in terms of insurance. Is that one of the positioning aspects that you're watching as well, this kind of positioning towards maybe insuring against the upside?
That is it. So one of the things we look at is typically when markets move higher, volatility should come down. So when you see markets moving higher and volatility going up, that means it's indicative that people are actually bidding up the upside to protect the right-hand tail. And then the other thing to think about is obviously from the retail positioning perspective, as I said, that has come down quite dramatically into this rally. So retail aren't participating quite as much as they were, say, this time last year.
Is this a market right now where you can still buy at current levels, or are you waiting for some kind of a pullback before you enter?
So I think the trade war dynamic over the next month is going to be critical in that regard. And so at the moment, you've got a lot of positive enthusiasm that we're going to get a resolution. But we have no date. We have no details. We don't even have a location that's been set. And if you recall, at the time in April earlier this year, we had that positive enthusiasm amongst US stocks when actually Asian stocks at the time were showing a very different picture. And it was ultimately the Asian stocks that were correct. And actually, I'm a little bit worried that we've got a similar setup right now.
One last thing before you go. Last year, we were concerned about the Fed. It might be tightening too much. This time around, we've got a Fed that's coming off an easing cycle, and it's now on pause. How much is the Fed going to be an upside or downside factor, or is it kind of taking itself into a neutral position for the market?
The Fed have told you they're in neutral, so what they really need to watch for is real rates. The Fed had done a really good job in driving real rates down from 100 basis points this time last year to basically 20 today. But if you recall, 100 basis points real yields was enough to completely derail the equity rally. My concern and my team's concern is actually we don't even need 100 basis points going forward. We need probably closer to 50. So what to watch for is not so much what the Fed do, but what they say and whether they can contain those real rates. And that ultimately is going to be whether equities can continue to rally or not.